Hi, this is Jason Gentile, Director of Financial Planning here at Apella Capital. Joining me today is Principal and Founder Pat Sweeny. Pat, thanks for joining us today. Really the purpose of today's video is there's been a lot of volatility going on in the markets here over the past month or two. Wanted to get your perspective on it and how it relates to the overall market.
Well, I think the first thing you have to talk about is perspective, and you have to put these numbers into some type of context for investors. And I think we should start with the recent volatility of the S&P 500. We can work back from there. Sure. The S&P 500 had a relatively smooth ride for the last several years, post-2009, relative to its history. And that makes investors complacent. They begin to expect net positive returns year over year. And they forget that a 10% drop at any given point in the market cycle, a 20% drop. So a 10% drop is a correction, a 20% drop is a bear market by most people's definitions. They are regular occurrences. And when they don't happen for some time, people get anxious when they do occur.
You know, it's interesting you say that and kind of how people view the market. Most of our investors are nearing in or, pretty far into retirement and are not in a 100% equity portfolio. You know, obviously we start building a financial plan, figure out which portfolio best suits them, but when people are looking at the headlines, the markets, they're thinking they're enduring everything that's occurring, and that's not really the case.
No, and something that we've learned a long time ago, Jason, is to try to encourage investors not to watch the financial media, at least with any regularity. Mm-hmm. The financial media, CNBC, Fox Business News, Fox Business outlets like this, tend to be, they tend to cater to people who trade a great deal, tend to cater to professionals, and they really aren't serving the best interests of typical retail or individual investors. Retail investors who have exposure to stocks, be it 20% or 80% or somewhere in between, they should have a 5 to 10 year time horizon for that portion of their money. And what's happening in the news on any given day is going to have very little effect on the outcomes they're going to experience over a 5 to 10 year time frame. Right. So probably one of the worst things they can do is react to what they see on financial news.
Yeah, I think one of the other things that happens a lot is somebody who might be approaching retirement. Obviously, that sequence of returns, you don't want to endure the worst market of your lifetime as you step into retirement. But it also takes some perspective to say, you know, I don't need every last dollar of what I've invested day one of retirement. It's there, it needs growth, it needs exposure to the markets over the long haul. Exactly.
So the retirement planning process should be in some way dividing people's money up between what they need in the first 18 to 24 months of retirement, what they're going to need in the intermediate time frame, and what they're going to need over 20 years or more. Life expectancies today are the longest they've ever been, and so people who are moving into some type of retirement in, let's just say, their mid to late 60s, they have a 20-year life expectancy. So this notion that I'm retired and I should be all in fixed income, I should have a regular income and no exposure to growth or stocks, that's a type of thinking that went out the window 20 years ago, and rightfully so. And so even in retirement, people shouldn't be overly concerned about the day-to-day volatility of the stock market.
You know, I think one of the more common themes I hear from investors today is how crazy the world is. It's never been this nuts. It's never been like this before. Yeah. You know, what light can you shed on that from your perspective?
You know what? If I had a dime for every time I heard that over my 35-year career, I'd be a wealthy man. So we all seem to have that same notion that things that are happening now are unique to this time and place and never happened in the past. And we have a nice piece that we can show investors about the timeline of terrible things. It just shows a history of what's happened in this country and around the world and how the stock market has moved over that same time period. And what we see is a left to right 45-degree movement of the stock market as measured by either the S&P 500, the Dow Jones Industrial Average, it doesn't matter. And the market goes up because really over time the market is a reflection of the fortunes of the companies that make up the market, as opposed to geopolitical events which tend to have short-term impacts on the market. So context and perspective are very important here. Over the last decade, we've had a half a dozen of these corrections where the market dropped 10% from one point to another. That's happened 6 times over the last decade. None of those times did it presage a downturn in the economy. Over the last 2 decades, over the last 20 years, we've had 10 corrections, and twice they led to a bear market. Yeah. So when you see the market moving up and down like it is, in typically short-term reaction to the news, it has very little impact with how the economy is going to react over the next couple of years.
You know, I think back to some of those more recent memories, like the 2008 stock market and, you know, September 11th, you know, even Nixon, Kennedy, things like that. There have been tremendous things that have happened in the news, and kind of going back to something you've said, that 24-hour news cycle and social media, it's just being peppered at us constantly right now. So we seem more hyper-aware of it, but it's not any different than it's
No, we absolutely are. So when I was younger, there was the 6 o'clock news. It was a 15-minute broadcast, and they expanded it to 30 minutes. And there was the Wall Street Journal, the New York Times, and your local newspaper, and that's where you got your news. So now people are getting it, they're bombarded with it. Yeah. And I think it just creates a heightened sense of awareness, which is not necessarily good to being a good, experienced long-term investor. An experienced long-term investor understands market volatility. Since 2009, the stock market, as measured by the S&P 500, at its peak was up over 300%. And now it's probably up about 250, 260%, depending on when people are watching this. So we're still up about 15% since the last presidential election. It was up 30% at its peak since the election. So what a lot of people engage in, and it's a common human heuristic, it's a common human attribute, is called recency bias. And whatever's happened very recently is what we extrapolate or think will happen again in the future. We don't look back to those times that you just alluded to and say, well, gee whiz, in 1995, when we started in this business, the market was trading at about 4,000 on the Dow Jones Industrial Average, and today it's about 24,000. So looked at in its proper perspective over the long term, the market's done extraordinarily well. And I would tell you, back to your original comment, right now, well, things seem a little crazy. I can't remember a time it wasn't contentious on Capitol Hill. I can't remember a time when there wasn't strife somewhere in the world, the Middle East in particular. So these things are cyclical, they come and go. There's nothing really that new happening here that should cause investors to panic. The stock market, as measured by the S&P 500, is down about 3% this year. So the last several weeks have been volatile, and they've spooked some folks. But it's down about 3% this year. That's not something to get really upset over.
So when we look at the S&P 500 and its performance over this past year or the past 10 years, depending on kind of what window of time you're viewing it in, that's obviously not the only place we invest.
No, and people look at the S&P 500 only because it's, or the Dow Jones Industrial Average, because it's on the nightly news, right? Or it's on their feed on their computer. And when you follow a type of investing that we espouse, which is not uncommon, a broadly diversified way to invest, we're unique in how we implement that, but certainly a lot of other managers will invest globally. Don't put all your eggs in one basket. I think that adage, which is really what diversification is all about, holds as true today as it ever has. But unique to this time period is a lot of people see the S&P 500 every day, and it has outperformed over the last several years a globally diversified approach. Well, what they don't realize or don't recall is from 2000 to 2009, just the opposite occurred. So you have a strategy that makes sense to you, and you follow that strategy, and there are going to be times when it's in favor, and you're happy, and you're not calling anybody. And there are times when it's out of favor, and I think that's where financial advisors really, quite frankly, make their money, when they're counseling clients about their accounts when times are difficult or volatile.
So in terms of that news cycle, we're sitting here today as the Fed just made its most recent announcement about their rate hike. Give us some perspective on interest rates and kind of how they impact the portfolio and the volatility, obviously, that is being caused by maybe a change in interest rates.
Sure. So broadly speaking, the Fed is raising interest rates because it keeps a lid on inflation. Inflation heats up when the economy heats up. So from the Federal Reserve's point of view, the economy is doing very well. And pretty much from everybody else's point of view, from inflation, jobs, the economy is doing exceptionally well right now. So the Federal Reserve raises rates to keep a lid on inflation. The politicians say, in many cases, we don't want you to do that. Let the economy, let's see how fast it can grow. We're looking at 2018 probably seeing about a 3% growth rate in GDP, which is outstanding. So there's that battle going on between politicians and the Federal Reserve. What does that mean to investors? Well, it means if you own bonds or fixed income, they'll be under pressure because when rates go up, the price of bonds go down. It's an inverse relationship. However, for savers, people living off their savings and living off fixed income, there's a positive to that as well, because rates going up means when they reinvest their money, they'll get a higher rate of return as far as the income they get from bonds. With stocks, there's no linear line to be drawn between stocks going up and rates going up, or stocks going down and rates going up. They tend to move inversely when there's a rate hike, but then stocks go back to where they're supposed to be going based on the fortunes of the underlying companies. The reason for that is some investors who are quite active in moving money around may see a fixed rate that's attractive to them, take money from stocks to put it in that fixed rate. But that's a short-term effect from a rate rise.
So as we look at the overall economy, things do seem fairly positive here in the United States, yet we've got all these different asset classes across the globe down for the year.
Yeah.
Rising interest rates, and as you said, that puts pressure on fixed income. What's an investor supposed to do these days?
What an investor is supposed to do is maintain that globally diversified portfolio. They're supposed to, when they get nervous or concerned, talk to their financial advisor. And what you want to refrain from doing is a knee-jerk reaction to change your allocation based on what you're seeing in the headlines. Changes in your allocation, changes in your portfolio, your account, should be based on, did you get a raise? Did you lose your job? Did you get an inheritance? All these life events should cause you to reevaluate your allocation. What's happening in the headlines shouldn't have any impact on what your allocation is, because this is a long-term planning document versus what's happening short-term. And I would tell you right now, from my perspective, having been doing this for over 30 years now, that the economy in the United States, by nearly every measure, is doing quite well. And markets have had a very long period of prosperity. And I would say this is healthy. People don't like to hear that because it doesn't make them feel good, but it's normal. Volatility in the stock market this year has been averaging around 10 to 12% historically. That's completely normal. It's right within the range of an average stock market over the last 100 years or so. So I think that it's our job to continue to educate investors and put them at ease. Those that are the most concerned right now are probably people who have invested in the past year some money, and they've seen that go up and then down again, maybe from the peak to the trough, as we say, 13%. That's a big move, and that's a little scary, but you have to revisit the fact why you're invested in equities, and that's because you want your money to grow long term. And over the long term, equities, stocks have grown in any country you care to look at over the long term. They've averaged around 10%. An average of 10% could be down 20, up 30, right, down 5, up 4, that type of thing. That volatility in the market is the price you pay to get the market's rate of returns.
I think it's also important too to, when we put folks into an investment strategy, whether it might be 70 or 80% stocks, we've done a financial plan for all of these folks where we know how much risk they can take or should take, what the type of return they should expect or are going to get from their portfolio. And we're testing for these things. We're actually,
exactly,
we have information about what the market has done in the past, and that's why you meet with your financial advisor every year, right? To sit down and review the plan. We planned on this, the market did this, how do we adjust from here?
I would tell you that if you're feeling real nervous and you can't sleep at night, you have to go back to your financial planner and sit down and chat with them, because maybe you're finding out that you don't have the stomach you thought you had for it. Right. So if someone says, I can withstand a drop of 10% in the stock market for the money that I have that's in the stock market, and I'll be okay, And then when that happens, you find that, well, I don't know if that's true or not. Well, then you have to revisit that allocation decision with your advisor. Maybe you shouldn't be 80% or 70%. Maybe you should be 40 or 60. So I think the most important thing is that people can sleep at night. And after that, then we can come to an agreement on an allocation within a financial plan that gets them where they need to go. If someone says you need to be 100% in stocks, well, you better be prepared for a 50% drop in your account value at some point in your lifetime. Maybe a couple of times that'll happen. And most people can't handle that, as you alluded to. So this is a gut check for a lot of people, and they're learning really what their tolerance risk is.
I think that's a fair point, you know, understanding the ability to take risk versus the stomach of that actual risk. But, you know, we've talked about it a million times. Stick-to-itiveness, you know, being in the markets is how you get the reward from the markets.
Yes.
So really, I appreciate you sitting down, talking about the recent volatility, kind of some of the things that are going on economically. And ultimately, the idea of this is to help people understand the markets, understand what's going on from a volatility perspective, to know that, you know, us, our research team, our planning team, is obviously reviewing everything, looking at everything. We believe in what we do, and you know, Pat, I definitely appreciate your time here and appreciate you watching.
Thank you, Jason.
Thank you.